Hi, welcome to Money Value Lab. In this video, I just want to show you, as a member in the Money Value Lab community, all of the resources that you have at your disposal. All of you now will be able to log on to moneyvaluelab.com. Your email address and your password will be the same. Then if you click on Forget Password, you will be able to change your password to the desired one. Now I will log into this website just to show you all of the resources that you have at your disposal. Now I'm logging on here, sign in. Now on the left-hand side, you have the letters. These are the letters I publish on a weekly, monthly basis. Here is, for example, the article I wrote about Michael Berry buying this furniture store, buying a stake in this furniture store in Australia. Then you have resources to the left. Here is my investment checklist. This is what I look at and analyze each company before I make a decision to buy or to pass that opportunity. Here in growth and value portfolio, here you have my portfolio in all of my holdings here. Then educational content. Here I will be publishing educational videos because I know that some of you members have requested that you want to learn about valuation, and this is on my to-do list, so it's coming. And then compelling ideas. Here are all my valuations that I've done on my companies. For example, here you have Adyen. Most recent valuation that I've done is Mercado Libre, and you have all of the things in the same place. So it's not like confusing like in, I believe in Patreon. You don't have everything in the same place. You need to search for something. So the website will be much easier for you to navigate. And for example, here I published the valuations that I've done on Mercado Libre. Here I did a dividend discount model on their financial service arm. And here I did a free cash flow valuation on their e-commerce segment. And you can download these directly from the webpage. And of course, not all valuations have migrated from my G Drive to this website, but it will happen. So soon you will have all of the valuations here. Now here's a specific feature that will be to the platinum tier, but I'm thinking of giving you this feature for free for a week so you could try this out. This is the valuation feature. So here you can value any company you want. So press on stock valuation. Let's assume, for example, let's value Sanara Medtech. Sanara Medtech is a company I've spoken about a lot. So let's value Sanara Medtech. You could just write the ticker symbol, SMTE. And here it calculates for you automatically the cost of capital. So this is the required rate of return that you need as an investor. And that is needed for the discounted cash flow valuation. So it does automatically all of the things for you. What you need to do is to just add what industry. So Sanara Medtech operates in the healthcare products. Then it gives you the beta. This is required in order to calculate the cost of equity. Here you add the risk-free rate. And again, don't worry about each field and what it means. I will have an educational video showing you what each cells means and navigate and supporting you with that. So you don't need to worry about that. But I'm just showing you here what you get as a platinum tier. So, okay, for example, the risk-free rate in USA is 4.33%, the 10-year one, the yield. The equity risk premium, this is what equity investors demand as a return from the stock market. I know this for a fact, it's 4.1%. Again, I'm going to tell you how I came to that figure in a separate video. So now the equity portion is already done. Now the debt portion, this dashboard extracts or imports the data automatically. So you don't need to do anything. Here it knows that Sanara Medtech has $48 million in debt. Here is the interest expense. So this is the book value. And in valuation, what we care about is market value. Everything is market value. So what this does is it converts the book value into market value. Put here 25%. Then it gives you that the market value of the debt is 48 million. So it's quite similar. No preferred stock, so I can just jump on. Now here's the powerful thing with this dashboard. It will give you the visualization of my investment checklist. Like, does it tick the boxes? Is this something interesting you should dive deeper into, or is it a company that you should stay away from? So here on the top, you have the industry and information about the company. Here you have the revenue, and the blue line is the gross margin. Red is the EBIT margin. And you can see here that EBIT margin has improved year by year. So in 2025, it was 8.9%. And now in the trailing 12 month, it was 10%. So Sanara Medtech is becoming more profitable as a company. And look at the gross margin. The gross margin is 90%. So now the spread between the gross margin and EBIT margin is 80%. This is what this donut chart means. So what it's telling you is that the potential increase on EBIT margin could be theoretically 80%. So this is really good. Sonarmatic could be a profitable company in the near future. I would assume they would probably be able to get to 30% EBIT margin without even struggling to achieve that. Here on the right-hand side, you have the compounded annual growth rate over the years. 34%. Now this is a really powerful metric here to the left. This is what does here is that it knows how much Sonarametic is reinvesting in their own business in form of working capital and capital expenditure, and then it can estimate what it will grow next year. So here it's telling you that based on Sonarametic's reinvestment, I assume the company will grow by 12% next year. So that is something you will need to value your company. Now here's something that I always repeat and have been quite adamant about in my investment checklist. I always want to invest in companies that create shareholder value, meaning they have a return on invested capital higher than their weighted average cost of capital. The weighted cost of capital is what we computed here. Cost of capital. This is what you get, right? 9.76%. It was quite easy. The model did everything to you. And here you can see trailing 12-month economic value added is positive. So what it's saying here to you is that Sonarametic is creating shareholder value. It's not destroying shareholder value, which is good. Also, final thing. Here is the sign. This can detect if the company is growing or declining, or if it's a mature company, or if it's a growth company. And here it detects that Sonarmetic is a high growth company. This is really important because just for you to understand that when you're going to project the revenues for the upcoming years, that you don't project too aggressive forecasts when you have a company that is declining, for instance. Here is the earnings per share, and you can see that for Sonarmetic, it has been declining, but now it's improving. The line chart here is stock-based compensation. This is really important to always factor in because you don't want to have a company which has too high stock-based compensation because then it will dilute shareholder value. And that is something to keep an eye on. And that's why you have it here in the dashboard. The PE ratio is price to book, but here you see PE ratios is blank because you can't calculate PE ratio for a money-losing company. So net income is negative still for Sonarmetic because it's a high growth company and they are soon, hopefully soon, they will become profitable. Here is a debt ratio. So in red, the long-term debt, in orange, the short-term debt. And here you have the equity ratio, the dotted line, and the other line is the net debt to EBITDA. And here it just shows you that Sonarmetic doesn't have the strongest balance sheet. Equity ratio is 10%, meaning 10% is equity, the rest is debt. So it's not the strongest balance sheet, but the most important thing is it looks at also at the short-term liquidity. So here you have a cash balance, 13 million, and you have short-term debt that is due 367,000. So it means they can repay their short-term debt without an issue. If you would choose, for example, Oatly or another company which have higher debt, short-term debt than their cash, then you would get a warning here. And here are the most important metrics. So at the top, you have the free cash flow. Free cash flow has been negative for Sonarmetic, but it's now increasing and becoming positive. And on the bottom, you have the reinvestment rate. This is what they reinvest in capital expenditures and working capital. And even though they've been reinvesting heavily, 71% reinvestment rate. So here they reinvested about 7 million, but still they were able to pull off 3.2 million free cash flow. So this is a really good visualization for you to see before you proceed with valuing the company. And then the final step is valuation. We're soon done. Here is a stock price. Before you press calculate value, you need to put your assumptions. On the left-hand side, you have the company specific ratio. So gross margin for Sonarmetic is 90%, which is really high. And how deep it's high? Look at the industry average. The company within the same industry has a gross margin of 53%. So 36 percentage points higher than the industry. So that's a win. EBIT margin, 10.2% currently, whereas the industry has an average of 40.3. However, you need to consider that Sonarmetic is a growth company. That's why you have a negative number here compared to the industry. Margin negative, as I mentioned before, Sonarmetic is a high growth company. So here you have the capital efficiency and the reinvestment rate of the company compared with the industry, which is a good thing for you to have before you continue on valuing the company. Here you have the company inputs. All of this has been inputted automatically. Revenue, operating margin, cash, all of that. Now what you need to do is you need to put your assumptions. This is where the sales input that will tell you need to put something. So if we go back to the dashboard, it tells you that Sonarmetic would probably grow by 12%. So I'll put 12% here. And then operating margin, currently they had 10%. right? 10% here. I would assume they would be able to improve that to 12% next year. And revenue growth for Sonara, I would, let's assume 10% every year for the 5 years. Then it will decrease down to the American risk-free rate. Target pre-tax operating margin. So it asks you here, what will the operating margin be in year 10 or when the company becomes mature? Well, look at the gross margin of Sonara. It's 90%. So they have a lot of leg room to improve their EBIT margin. And it's higher than the industry, meaning that they will, given that they have higher gross margin than the industry, then they will also be able to pull off a higher EBIT margin than the industry. Let's say 30%, or let's put 30% here. And it asks you, when do you think that operating margin will converge to 30%? Is it within the 2 years? I'll put 10 years. Then sales to capital. This is a question of how much revenue do they get for each invested dollar in their business. So the higher the sales to capital, the more capital efficient the business is. The lesser, the more capital intense the business is. So you're probably wondering, what should I put? Well, let's use the reinvestment rate of Sonara during the 10 years. It has been negative -2, but I think it's too dangerous to look at that because reinvestment rate can become negative if you are a money losing company. So let's use the industry. It's 50%. So if I put here 1.5, let's see what I get as a reinvestment rate. Now, if I scroll down, and you can see here, this is the cash flow table. So based on all of the inputs you've added, it will give you this cash flow table. And you can see here, right, we put 12% revenue growth next year, so it will increase revenue to 120 million. And I said 10% during the 5 years, then automatically it will decrease down to the risk-free rate, 4.33%. So year 10, I'm assuming Sonara will have a revenue of 251 million. Now, operating margin, I said 12%. And I said EBIT margin will converge to 30% in year 10. And you can see here, EBIT margin is improving year by year. And let's look at the reinvestment rate. It's 74%, 56%, 46%. Close to the industry average. So I'm not off here. But also you can look at is return on invested capital. If it's getting too high, then it means you're investing too little into your business. So what was the return on invested capital for the industry average? It's 13.7%. And the current return on invested capital is 26% for Sonara. So I'm going up 30, then I'm 37. This is becoming too high. So let's increase sales to capital. Let's increase reinvestment by decreasing sales to capital to at least lower the return on invested capital so it becomes more realistic. Now, as a default, return on invested capital will equal cost of capital, meaning that once the company becomes mature, competition will increase and it will have a difficulty earning higher than cost of capital. You can, of course, override this. You can do that with super companies like Alphabet, Google, etc. But for Sonara, I will not do that for now. Then you're done. Then you just press calculate value. And here you could see that the value per share I get for Sonara is $37. Current stock price of Sonara is 22. That's a 68% upside. And what you could do then is you could just press export report. So you're going to get the DCF table with all of your assumptions in a PDF and in an Excel file. That's how simple it is. And I want you to start thinking of what the valuation means. Valuation is a combination of growth, cash flow, and risk. And this is what this models incorporates. This model will give you the exact value. It's just up to you to give it the assumptions. So you don't need to be an expert here. I've taken care of that for you. Just need to put your assumptions. And I think the best way of learning valuation, if you're interested, is to do your own valuations. And then, of course, when I start to releasing educational videos, you're gonna know more about in depth what free cash flow means, what equity risk premium means, what risk-free rate means. That will build a much stronger foundation for you. And hopefully, my goal is to increase your knowledge within valuation so that no friend of yours or you're sitting on a bus and someone tells you, hey, this stock is worth 300% more than the current today's price. Instead of you just hanging along and leaving that assumption, you could go here and do your own valuation. You just put which company, you put your growth assumptions, reinvestment, and you base it on the industry. And then you don't need to guess anymore. Hopefully you found this video interesting and that it helped you. And of course, as a gold member, you will have all of the features here except for the stock valuation. That's only for the platinum members. But again, I'm thinking of giving you this for 1 week for free so you can try it out, value your companies. You don't need to wait for me. And I will only say one final thing is that I will add this tutorial video for you so you could then start valuing your companies. If you have any questions, please just feel free to email me at moneyvaluelab@gmail.com. Thank you for listening, and I'm really happy to have you as a member.